Welcome. In this video, we're going to go over what the stock market is, what stock options are, where can you find them, how do you buy and sell them, and the tools and platforms that we use. Let's dive in. So, understanding the stock market, it's not as complicated as you might think. Now, the stock market is basically made up of public companies and they offer their shares, also known as stock, which gives people pieces of ownership in their business. And you can buy and sell these things on the stock market. It's a way for companies to raise capital by selling pieces of their company to the public, and investors can invest in these companies by buying shares and start being part owners of these companies. Imagine if you had a smoothie shop and you're able to grow that smoothie shop to 5 locations. And yes, those locations were all profitable, but you wanted to expand to multiple other states. And the only way to do that is you needed a lot of cash. One thing you could do is you could list your company as a public company on the stock market, and you can offer up a portion of your company as shares, and then you can utilize that capital to expand your business. And you don't necessarily have to allow investors to have pieces of your profit, but as your company goes up in value, those shares are going to be up in value. And then the way that the value of that company or that share of that stock goes up and down is the more people that want to buy the stock, then sell it, then the price goes up. And the more people that want to sell the stock, then buy it, then the price goes down. And there's a lot of different things that could affect how much a stock is. It could be the economy, whether it's strong or weak. It could be how the company is doing, if they're performing well, as well as it could be things that are happening around in the world. Now let's jump into what options are. Options allow you the ability to control 100 shares of a company's stock without the obligation to have to buy them. And you're able to control them at a certain price, which is called a strike price. And you can control whether you want to buy or sell them at that specific price and by a certain date, which is the expiration date. Now you have two different types of options. You have call options, which gives you the right to buy, and then you have put options, which gives you the right to sell. But once again, you do not have the obligation to have to actually buy or sell them. Why do options matter? See, options allow you to leverage the market movement without having to put up a lot of investment. You can use very minimum investment and you can still be able to have the opportunity to profit from these stocks without actually owning them outright. Now let's dive into what makes up an option. They have four main pieces to them. The first one is strike price. The strike price is what the stock can be bought or sold for, no matter if the price goes up or down. Then you have an expiration date, and every option has an expiration date. If you don't use the option by that date, then it expires worthless. And dates can be just a few days or a few weeks or a few months, as well as a couple of years. Then you have what you call premiums, what you pay in order to have that option to buy or sell it at that specific price. Last thing that makes up the option is the multiplier. Now, when you buy an option, it allows you to control 100 shares at a specific price. And so the multiplier is 100. Let's say each of those shares, the premium is 50 cents a share. So you have to pay 50 cents a share. There's 100 shares. That's the multiplier in that one contract. So you have to pay $50. Let me dive into an example to show you how to think about options. So let's say that you go to a car dealership and you want to buy this new BMW. And when you walk in there, the BMW is worth $75,000. And let's say it's not in stock right now. So you want to buy it, but they don't have it. The dealer says, hey, I'll sell you the option to buy this at $75,000 and you just have to put down $1,000. So you pay me $1,000 and when the car does come in and you're ready to buy, you can just use this option and you can buy it at 75,000. And that option expires in 30 days. My expiration is 30 days. My premium is $1,000 and it gives me the option to buy the vehicle without actually taking ownership of it. Let's say now 3 weeks go by and that car becomes very popular and goes up in price. Now the car is worth $83,000 and I have an option to buy it at 75,000. and I've already put down $1,000. So now my option is actually worth $9,000 because that's the difference. Now, obviously, we know that anything that you want to sell is only worth as much as somebody's willing to buy. So we put it out on the marketplace and we see if we can find a buyer that wants to buy our contract. Now, this buyer is going to buy the contract from us for $5,000 because it's going to allow him to go now to the dealership and buy the vehicle at $75,000, which then saves them $3,000. Now, our initial $1,000 investment, we were able to quadruple that and turn that into $5,000. The buyer was able to then take that contract and save $3,000 and buy the vehicle at 75,000. So it's win on both sides. Now let's actually dive into an example using an actual option. So let's say we want to buy Apple stock and we believe that Apple stock is going to go up. And right now it's $178 a share. We can buy a contract that gives us the option to buy Apple at $180 within the next 7 days. The premium of that is 50 cents a share. And we know that one contract allows us to control 100 shares. So if we buy one contract, we have to pay $50 to be able to control 100 shares at $180. Now, let's say 3 days go by and that Apple stock now is worth $185. Now, our contracts and our premium on the contracts have gone up an additional dollar. So now we control 100 shares at $180 and our premium is $150 per contract. So now our contract is worth $150. Now we can go and find a buyer at the marketplace and sell that contract to that buyer for $150. So we get back our $50 and we make an extra $100. So we've basically been able to triple our money. And in return, that buyer now can execute on that contract and buy 100 shares of Apple at $180, even though Apple stock is worth $185. So they're able to save themselves $5 a share, which then saves them about $350. So it's win on both sides. Now, you should be able to see the difference between buying and selling stocks and buying and selling options. See, if we were to have to buy the stock and want to make that same $150, we'd actually have to buy Apple at $180 and we'd have to buy 30 shares, which would cost us $5,400. And then 3 days later, when Apple goes up to $185, we would then turn around and try to sell those shares for $550, netting us $150. But we would have had to use a lot more capital. So now you can see why options are a little bit more desirable and why they're more profitable. Because when you're buying stock, you have to actually put up the upfront capital to buy and own that stock in order to sell it. But with an option, we can put up a very minimum investment and we can capitalize on that stock going up or we can capitalize it on going down. Now, downside of an option is if we're not able to sell it or execute that contract before the expiration date, then we do lose our premium. Now, granted, it is a smaller investment. As long as we win more than we lose, then we don't have any issues or concerns. And if we use proper management, then we won't have that issue either. There's two different types of options. When the stock goes up, we would buy call options. And call options, they have expiration date, they have a strike price, and they give us the right to buy a stock at that certain strike price. And when that stock moves down, we can then buy put options, which then gives us the right to sell an option at a certain strike price. How do we actually buy and sell these options? We have to go to a marketplace that's called an exchange. An exchange is just a marketplace where stocks and options can be bought and sold. And there's three major exchanges out there. The one that you're probably most familiar with is the New York Stock Exchange. You've probably seen it in movies before, where they have a physical trading floor. And it's one of the largest and oldest stock exchanges in the world. But they primarily only focus on buying and selling stocks. Then you have what you call the NASDAQ. And the NASDAQ is a network of computers. And it's home to some of the highest technology standard companies, such as Apple, Amazon, and Google. So just think about these exchanges as just marketplaces. So these companies go public and they issue out a certain number of shares, and these shares are all housed at these exchanges. Now, the third one's called the Chicago Board Options Exchange. Now, this is the largest option exchange in the US, and they solely focus on just trading option contracts. Now that you know the marketplaces where these options and stocks are sold, how do we actually connect to the exchange? You connect to the exchange using a brokerage account. And a brokerage account is similar to an online bank account. It just provides you access to the exchanges. The one that we recommend is Charles Schwab, and I'll jump into why we use Charles Schwab. And then there's other brokerages such as Fidelity, Vanguard. I'm sure you have heard of Robinhood as well as Webull. Now, I wouldn't say that those are really good exchanges when it comes to buying and selling options. A lot of these are really good for just buying and selling stock. Now, when it comes to buying and selling options, this is why we go with Charles Schwab because of their software is very user friendly and makes it very easy to connect to our broker, and then our broker connects to the exchange. And they use a software called Thinkorswim. And Thinkorswim is probably the industry standard when it comes to buying and selling stock options. The software makes it very easy for us to be able to buy and sell these options in a matter of a couple seconds.